Let's bring in Kevin Green, senior markets correspondent, right away to help set up the action today. All right, all eyes on the Fed today, KG. So let's talk about it, right? We know what the expectation is, but really it's also about the optics of who's at the table now. Tell us kind of where things stand, especially for people who aren't caught up on Stephen Myron.
Yeah, well, we did see Stephen Myron get confirmed by the Senate yesterday, pretty much on party lines. So he will be a temporary Fed member, at least for now, up till January 31st here. Now, he is also going to keep and remain his position within the White House, but there's a little bit of a structure item that they're going to do in order to try to make it appear that there's not going to be a conflict of interest. But obviously, there's been a lot of questions around that, which is why we saw that split vote yesterday. But we also see the fact that Lisa Cook is going to be able to vote within this meeting as well. We did see an appeals court actually shoot down the Trump administration appeal in order to remove Cook from the position here. Now, that was also split on party lines. Two of the judges were Biden appointees. One was a Trump appointee. And we probably will see this challenge go up to the Supreme Court. So the market right now is pricing in at least 25 basis points for tomorrow. Could we see 50 basis points? That could be the case. But I think the big wild card that we have here, Diane, is really the summary of economic projections. Where do we actually see rates going into next year or remaining at the end of next year? And do we actually see a re-rating a little bit higher when it comes to the inflationary picture? That would also provide us maybe a sense of the urgency that the Fed actually looks at the labor market and potentially some weakness that we have there. So equity markets obviously moving higher because of this. Yields, especially when you're looking at 10-year, 20s and 30s, moving to the downside, 10-year sitting at around 4% or so. And you also see the dollar actually weakening, the weakest dollar that we've seen since July, which is usually the signal that we will see aggressive rate cuts here in the near term. And that's where the market kind of sits. Everything kind of is, I wouldn't say it's a Goldilocks situation, but the market is really kind of anticipating that we will have favorable rates that could also spark economic growth here. And the Fed, once again, will be in focus. Powell's commentary, I think, is going to come in second tomorrow. I think the first thing that we're going to focus on is going to be the summary of economic projections.
Right. So the summary of economic projections, because we'll see if what the market is projecting lines up with, where we see policymakers seeing rates by the close of this year. I'm curious to know this because, look, we're obviously paying a lot of attention to the records in equities, but at the same time, you have gold hitting record highs.
Yeah, well, gold is obviously looked at as it could be an inflation hedge. It could be a risk hedge when it comes to geopolitical risk that is out there. So gold is going to move higher, generally moves higher when we have a favorable rate market that also could lead to inflation moving higher. And so that's where you still see a lot of this optimism, not only in gold, but also in silver. You also have the fundamental structure there where central banks continue to buy gold, kind of divesting themselves away from U.S. treasuries. And then you also have the retail traders as well that continue to get into these futures contracts here. So gold continues to rise. And we will see once the dollar kind of stabilizes here, that probably will be a headwind for gold. But as the dollar continues to go down as well, gold generally trades inverse to the dollar. So a nice move when you're looking at the precious metal. But I think this market is really kind of pricing in an early 90s, mid 90s type of cycle, Diane, where we run the market hot. We do have persistent inflation. Labor market kind of stays intact. Housing market kind of heats up a little bit here, and we try to have this economic growth expansionary story. And the goal is to be able to have GDP growth and wage growth outpacing inflation. Even though inflation could be sticky at 3% or what have you, if you can outpace that with wage growth as well as economic growth just in general, then that's net positive for the United States. The biggest risk that you have with the 90s is what happened kind of the late 90s, where you kind of have these bubbles really forming. You have a lot of speculation taking place, and you have unchecked credit risk that kind of permeates itself throughout other markets, and that's the big risk that you have. So I think that's where the market is really kind of pricing in. And then this time next year, or when we're looking at March or even April of next year, then you start to question about the balance of the Fed, and that could actually push rates a little bit higher on the longer end of the curve. But for now, we're kind of focusing 3 months out, and 3 months out, the market's saying 75 basis points kind of on the table here for the remainder of this year.
And KG, let me ask you this. So Ben Emmons put out a note this morning, and he says the sell the news risk is high in terms of especially delivering what's expected, 25 basis point rate cut. Do you see things that way?
Yeah, we could definitely see a little bit of a re-rating higher. I mean, this is the same playbook that we had last year. It's actually almost one for one what we saw from last year. We had some labor reports that were really weak. The August data set generally is weak, and that's exactly what we saw. The market freaked out last year. We saw the rate cutting cycle actually taking place, and we started seeing yields actually moving higher. So we kind of overstep when it comes to the anticipation and then back off and try to re-rate compared to the Fed statements here. I'm not sure if you're going to get a straight up, dovish Powell tomorrow. I think he's still going to be measured when it comes to the data, but he probably will stress the labor market weakness and concerns about the labor market weakness a little bit more than inflation, which it seems like now the tone from some Fed members is that tariffs are going to be a one-time inflationary push that will go through the economy. I think the big risk that you have there is the layering of these tariffs. And since it wasn't done all at once, it's kind of going on month by month and things of that nature here. Could that actually prolong inflation? I think that's really the risk that you're seeing. I think Austin Goolsbee has mentioned that, as well as others within their inflationary look for next year. So 25 basis points on the calendar here. I wouldn't look too far out, Diane. There's way too many variables right now to say what's going to be the Fed funds rate 6 months from now.
Okay, so not looking too far out, but at least for today, I want to know your targets for the S&P 500, especially since we crossed that 6,600 milestone. And I remember when there were calls earlier this year, and some stood by those calls of 6,600 for the S&P 500. Where do we go from here to the upside and downside?
Yeah, for today, looking at 66.45 to the upside, 6,600 to the downside is your first area of support here. Volatility is re-rating a little bit higher. Be mindful of that, but a lot of that's actually just mechanical. We have quarterly expiration, so you're seeing an uptick in SPX hedges for December, as well as an uptick in VIX options being traded. And today is the last day for the VIX options being traded as well. So VVIX or vol probably will still be elevated and continue to move higher. And the big thing for the bulls here is that you would like to see volatility edge up, going into the FOMC meeting and then crush. That gives you kind of a slingshot effect to the upside. We have seen that several different times this year. You would hope that this is going to be the same and we don't get any surprises from the Fed.
Okay, and I want to get a quick assessment from you on Oracle. Shares moving higher once again today.
Yeah, we are seeing Oracle catching a little bit of a bid. Now, this is a story that's been out there for a fairly long time. There is the market speculating that Oracle will have a little bit more of an impact or get their hands into this TikTok deal. And if we are going to see one being generated, Oracle could be the hosting services for that or even something more. And so you are seeing the market actually bid up the stock this morning because of that enthusiasm. Once we have a lot of rhetoric, we don't have anything on paper yet when it comes to TikTok, but apparently when you're looking at this platform, it has become a very big staple, if you will, or a very big chess piece when it comes to the overall trade deals between the U.S. and China, and that's really how it's being played. So Oracle has seen some tailwinds there, but you did not see an aggressive re-rating to the downside for other social media stocks, like a Meta, for example. In fact, you actually did see Meta actually perform pretty well. So the market probably is already pricing a lot of this in, but that's why we're seeing the pop this morning. Let's see if it's going to be able to sustain itself.
I noticed that with the other social media stocks like Meta and even Snap, for instance, it didn't seem like it was causing any major damage. All right, KG, we'll leave our conversation there for today. That's our Kevin Green, Senior Markets Correspondent. Appreciate it.